Sri Kamlesh Shah, President of ANMI, other office bearers and friends. Good evening. I don't know, I think this is my second seminar on GST on behalf of ANMI. Some of you might have attended my earlier talks also. So I wouldn't like to repeat the background, complete background, why GST, what is the justification for GST. I would not go into that. But undisputedly, this is going to be the most paradigm shift taking place in the country in the field of indirect tax ever. And the impact of which will be felt for decades to come. Without any doubts whatsoever, the life will not be the same again for anybody in this country once the GST is ushered in. Be it a manufacturer, service provider, or person from the distributive trade, and including the end consumers. Not to speak about the professionals. Nothing would be the same again. And in near couple of generations, I am not expecting, visualizing any major change coming place which would replace GST. There could be different variants of GST, like OECD with IMF, World Bank are already discussing, contemplating the various forms of GST, like variable VAT, compensatory VAT, split VAT, refund VAT. But whichever may be, but this philosophy is likely to stay here for a few generations. So everything which we have understood, learned, experienced, and implemented in the form of indirect tax laws during all these decades will be finally and permanently will be relegated to the past. So it's a challenge, it's a biggest challenge which a taxpayer in any capacity would face in this country. The philosophy of VAT, before we get into that, just simply to put it very simply, the taxation powers which are divided between the center and the states as per the constitutional mandate, Article 246, Schedule 7, Union List 1, State List 2, Concurrent List. That is actually ensured that center cannot levy the tax beyond the factory gate and states cannot levy the tax on the services. So the center's province to levy the tax on any business activity stops at the factory gates of the manufacturer. Center cannot levy any tax on the distributive trade. CST, no doubt, it is being levied under the Central Sales Tax Act 1956, which is a central legislation. In effect, it is basically a state tax in the sense that the entire income accrues to the state from where the origin of the movement of the goods to another state lies. So from that perspective, it is an origin-based tax. As against that, states cannot levy the tax on the services, which is the exclusive province of the center. This is unknowingly or inevitably resulted into the cascading effect of tax on tax. Today we are having the plethora of indirect taxes being levied by center, by the states and by the local bodies. Central excise, service tax on import CVD, SAD, additional excise duty of goods of special importance, additional excise duty textile and textile articles, cesses, surcharges, the plethora of indirect taxes levied by center. Similarly, at the state level, VAT, for that matter CST, cesses, surcharges, entertainment tax, purchase tax, luxury tax, entry tax, and at the local level, prominent LBT or octroi. These are the few, not to count stamp duty, property tax, road tax, passenger tax, goods tax, toll tax, green tax, and on top of that, all type of cesses which we are facing. Now, when all these indirect taxes which are being levied on the business activity being conducted by a person in any capacity, what happens is that there arises the cascading effect of tax on tax. And how does it arise? Please understand two main characteristics of the indirect tax. The first is all indirect taxes are consumption taxes. They are in principle imposed on the consumption taking place in the country of goods or services. All are consumption taxes, and therefore ultimate burden is passed on or is to be borne by the consumer or customer. This is first characteristic. And the second, which has more relevance from the execution perspective, and that is all indirect taxes are transaction-based taxes. Every single transaction may invest you with the rights, but at the same time may create obligations against you. This is unlike the direct tax like income tax, where there are blocked assessment. So a taxpayer does everything during the year, and at the end of the year, the chartered accountant comes into play and he sets right everything in the manner we want him to do. This does not happen when you are dealing with the transaction taxes like all indirect taxes. It is like once the transaction is entered into the system, it is indelible, it is eternal. This part I am mentioning only because in the context of GST, this transaction-based character of GST may assume significance, very, very significant importance also. Now, being the consumption-based taxes, they are to be levied on the consumption. So the tendency on part of a taxpayer who is paying any indirect tax in any form whatsoever is to really pass on and recover it. And rightly so, so long as he recover, nothing wrong in that. But at that stage, he is recovering and paying it to the government. So the taxpayer is acting as a collection agent for the government. He is purely a collection agent, sans any remuneration whatsoever. So as has been rightly said, that everybody today works for the government. Either they are on the payroll or on their tax roll. We are not fortunate enough to be on their payroll like the Sarkari Jawai, but we are on their tax rolls. So we are collecting and we are recovering and we are paying it to the government. But still, if taxpayer is unable to recover the tax, then obviously the liability still rests with the taxpayer. In the case of indirect tax, that is one. Now, the loading of the indirect tax in whatever form in the prices stands reduced or mitigated, the impact stands mitigated to some extent when a credit is provided to the taxpayer. When the credit is provided, then obviously it does not form part of the cost of the product, whether it is goods or whether it is service. And to that extent, lesser burden is passed. Now, because of the division of taxation powers between the center and the states, the first anomaly which arises today in the indirect tax sphere in the country is that the manufacturer cannot take the credit of the VAT to be offset against central excise. He can take the credit of VAT to be offset against VAT. Trader cannot take the credit of the service tax. The CST is not available by way of credit to anybody. No credit is available of purchase tax, luxury tax, entertainment tax, LBT, entry tax, octroi, or any such taxes. This is not available. Now, the taxes which are being levied on the transaction at whatever stage and in whatever manner, when they are not allowed to be credited, then it becomes part of the cost. So, a stockbroker buying the goods on payment of VAT for its day-to-day business activity, when unable to take the credit of that VAT, because ultimately it is paying only the service tax on its activity, then that VAT liability becomes part of his cost of operations, to put it. And this is the cascading effect of tax on tax, which is somehow or other it is an inevitable feature, and the problem does not lie with India. We have peculiar problem because of the federal character of the country. This problem has been a part of the indirect tax policy all over the world. All the countries have been facing this. And from there, basically, and apart, the idea of the VAT sprang up. And that was way back in 1919 in Germany, where at that time, the prevalent cell tax structure, cell tax policies of the Germany was as bad as ours as before prior to 2005, before all the states and union territories switch over to VAT. It was as bad as ours. How much bad? In the words of late Dr. Amresh Bagchi, one of the noted economists of this country, who described the then prevalent cell tax system of India as the most archaic, irrational, and the most complicated, according to the knowledgeable experts, most complicated in the world. The sentiments which were echoed by the Empowered Committee of State Finance Ministers in its white paper released in 2004, just prior to introduction of VAT in the country. So Germany was facing, and these problems were multiple. Apart from this cascading effect of tax on tax, the other issues have been multiplicity of taxes, as you say, number of indirect taxes, opening up number of tax windows, taxpayer dealing with multiple tax agencies day and night in the country, which is right now going on. The second. The third, plethora of exemptions. Though credit regime has been expanded with the passage of time, still in the arena of the central excise, in the context of Senvet Credit Rules 2004, this, or even for the purpose of VAT credit, with the widening tax horizon, the credit footprints are still shrinking. So we have on one side the tax horizon which is getting widened and widened, particularly for instance in 1994, 2012 when the negative list-based levy of service tax regime was introduced, there was a massive coverage of the services within the service tax with this negative list-based levy. So the tax horizon has exponentially widened, but at the same time, your credit footprints with the restrictions built it into the Senvet Credit Rules, it has really reduced. It has shrunk. So there is a double whammy as far as the taxpayers are concerned, trade and industry are concerned. Now, and on top of that, this country, the taxpayers in this country, they love just exemptions. We just want our activity to be exempted in one way or another, scarcely realizing that when we talk about the credit system, exemptions cannot have the place, because exemption breaks the credit chain. And when it breaks the credit chain, then the distortions in the system arises in number of ways. One of them is the person would always try to remain within the four corners of the exemption by hook or crook. 1.5 crore exemption to the manufacturer, small scale industry, he would try to see that he remains within 1.5 crore. The moment he is about to cross 1.5 crore, he will simply change the patia and do the same activity in the same manner under another guise. Similarly, a service provider enjoying the exemption of 10 lakhs under 33/2012 small scale notification service tax, he would again try to see that today up till now he is providing all services in his name. The moment he is about to reach 10 lakh, then the same service he will continue to provide but in the wife's name. So any number of distortions can arise when you have such type of exemption system. Exemptions and credit are both on the opposite poles. Because when we talk about cascading effect of tax on tax, when there is no tax on the output activity, there is no place for the credit on the inputs. That is fundamental. Then the partial coverage of the activities, goods or services within the tax net, whether central or state level VAT taxes. That is another issue. Compliance burden. And the most important thing are two. One, all this arrangement has ensured that India, one country, has never had a borderless national common market. A market where a person can manufacture anywhere he wants to, sells wherever he wants to, and buys from wherever he wants to. Such common market, common national market has never been able to created. In the context of manufacture, it would be very easy to understand that today with the MRP based levy being in vogue and with the CST 2%, Almost all the FMCG countries were perforce required to resort to branch transfer, stock transfer, creating small warehouses in every state, just to maintain the parity of the prices for the consumers everywhere throughout the country. Then we have exemptions under excise, we have exemptions under service tax, mega exemption 25 by 2012 ST running into almost 20 pages. So it creates discrimination between two similarly placed taxpayers. For instance, again in the context of manufacturer, one manufacturing goods in Maharashtra, pharmaceutical products, another manufacturing goods in Baddi in Himachal Pradesh, which is enjoying the backward area exemption notification, no tax there, all tax is leviable in Maharashtra. When the Baddi was announced, almost entire Gujarat, which was the pharmaceutical hub of the country, there was a exodus, overnight exodus of all pharma companies to Baddi, with no regard whatsoever for the availability of the resources, transportation, logistics, capital, labor, all four factors of production, Adam Smith, nothing. There are tax exemptions. Rest of the thing I will take care. What is compromised here is the principle of neutrality. This principle of neutrality, which is one of the most important and which is the core feature of the indirect tax, or ought to be, that is completely neutralized. And what happens is, when an entrepreneur is planning any adventure, business adventure in whatsoever field, service, manufacturing or trading, whatsoever field, or for that matter even profession, the first question in the country the person will ask is, what is the tax burden on my activity which I propose to undertake? And what do I do so that I can avoid taxes? So the tax is the forefront, at the forefront for his entrepreneurial decision. His decision is influenced by the tax consideration instead of demand supply, instead of the core capacity or competency, instead of expertise and experience, instead of the resource availability, instead of logistic and transportation. These are the factors which should actually really guide the entrepreneurial decision to enter into a particular project, not the tax consideration. That is not happening in the country. So, and with the origin-based tax, there is a peculiar situation arising that going forward theoretically, the exports taking place in the country, from the country, are taxed, and the imports coming back into the country, they are being refunded. Theoretically, in origin-based tax culture is that when something is imported, then hypothetically, whatever tax might have been paid would have been refunded. This cannot, these anomalies, I'm not going into the technical part of it, but this is another feature. Now, this cannot be set right in the current regime when we talk about goods and services tax. Because when the center and states cannot levy the tax concurrently and simultaneously on the common tax base, which requires to be done in GST. Because in GST, what is required is both center and the states will levy the tax on a concurrent level on the same tax base. Which required, obviously the first thing is the constitutional amendment. All these amendments were carried out through the Constitutional 101st Amendment Act 2016, which was passed, which was enacted on 16th May 2016. That paved the way for the introduction of GST in the country. And the other two aspects was, we needed a system which is distributionally attractive, operationally simple, capable of broad basing the tax base, reducing the compliance burden, ensuring that the neutrality is not compromised, but at the same time, it should be capable of ensuring the federal character of the country. Because neither the center nor the states would compromise or give away their rights to levy the taxes which are guaranteed under the Constitution. And therefore, we have a dual GST structure. Unfortunately, because we will never have a unified GST. The one nation, one tax can only be understood to a certain extent, to this extent. It is one tax named GST, but in effect, it is a dual GST structure. The one part of it is a central GST, other part of it is a state GST. And on the interstate supplies, there will be integrated GST, which is sum of the CGST and SGST. Unified GST or one national tax which is being levied, for instance, Australia is a federal country, but where unified GST is being levied, where union recovers the whole taxes and then distributes the entire tax to the states or provinces. We can only, for us, it is like a utopia. We can only dream about that, not likely to become a reality. So even the center, it proposes to cover the taxes, recover the taxes, that we will give you everything on the basis of the predetermined formula guaranteed by Constitution. Obviously, the centers would not and do not trust, particularly after the CST fiasco. The states do not have much trust on center, and that's why they wanted this compensation-related issue for 5 years, 100% compensation for the loss of the revenue on account of GST to be enshrined in the Constitution only. Because we don't trust you. Unfortunate, but that has happened. So the dual GST structure is here to stay. This part is here to stay. It has its own ramifications or implications. We will see that. So finally, keeping aside everything, the two aspects in this background, we'll just remember that for better or worse, GST is now here, is coming from 1st July or 1st September. According to me, it doesn't matter whether 1st July or 1st September. Even if it comes beyond September 16, 2017, unlikely, but not impossible. But it's a legal issue, so I will not go into that. But whatever, the time is short. The time was never there. Right? So the clock is ticking. I don't know, but at 11:59 on 30th June, the last invoice will be prepared, will be either under excise or service tax or VAT. At 12 o'clock and 1 minute on 1st July, the invoice has to be under GST after 2 minutes. And this is mandatory. There is no switchover time, no breathing period in between. The system has to take place that the first invoice issued after 12 o'clock in the night on 1st July will be under GST. This is the level of transition we are talking about. So the all the anomalies or shortcomings of the current indirect tax system at the center and states, policymakers found that GST could be an answer. Similar type of problems I was talking about Germany in 1919, and Wilhelm von Siemens advanced the idea of VAT. For our purpose, VAT and GST, we will use it as a synonymous words. There is a hairline difference between the two, but it is more academic, so I will not go into that. For us, it is same. So he promulgated this idea of VAT way back in 1919, mainly with three purposes. One, to mitigate, if not altogether obliterate, the cascading effect of tax on tax. The second was to ensure that there is no vertical integration of the taxes in the country. And the third one is basically to broaden the tax base. With these three the aims, he gave the first time, he is credited with this, that of the VAT. And what did he propose? That allow the credit, every person should pay VAT on whatever business transaction he is undertaking in whatsoever manner, and he should be allowed to take the credit of whatever VAT he pays on his procurements. So in effect, the tax he is paying is only on the value addition. However, for 30 years, there were no takers of this idea. France was the first country to adopt it in its full form against its price in 1948. After 20 years, Brazil became the second country to adopt the VAT, and thereafter, this particular tax policy has never looked back, and in last 50 years, 165 countries have joined the GST or VAT club all over the world. The only notable exclusion is USA. Otherwise, barring USA, all OECD countries are part of the GST or VAT club. The latest country being Malaysia, which again entered the club on 1st April 2015. As has been noted by Bird and Gendron, international VAT experts, at no time in the history of mankind, a tax policy has been accepted so widely and so fast. In 50 years, almost 165 countries, and we are now destined to join this GST club in another. 1st January 2018, UAE, United Arab Emirates, is again adopting the GST. All Gulf countries will be GST compliant maybe in another couple of years. In right earnest, the exercise is going on in Saudi Arabia and everywhere. So all Gulf countries will be also part of this. The Ottawa Taxation Framework Network, paper of 1998 released by OECD, talked about certain characteristics of a tax policy. Certainty and clarity, flexibility, fairness, and these are the various, neutrality, effectiveness. So these are the characteristics which should be there possessed by any. We will have to probably test the GST laws on the touchstone of this one thing. That is one part. And the second part is about the law as proposals. If I have to sum up in the beginning itself, that there are multiple aims of GST, but probably in the current scenario, it may probably help to achieve to some extent 3 aims only. The first, the avoidance of cascading effect of tax on tax with much broader availability of the credit. The second is creation of an integrated or national market for the free flow of supply of goods on sale. That is second. And third, the reduction in the multiple tax windows with the taxpayer dealing with only the one tax window ineffective, but at least from the GST perspective, it could be state, it could be center. Because GST will subsume excise, service tax, all additional excise duty, CST, VAT, octroi, LBT, entry tax, purchase tax, luxury tax, entertainment tax, except to be levied by the collector, entertainment tax, that will continue. But apart from that, all cesses, surcharges, rubber cess, sugar cess, green cess, road cess, everything will be entirely on imports, CVD, SAD, everything will be subsumed by GST. What will remain is stamp duty, property tax, toll tax, passenger tax, road tax. These are certain taxes, including electricity. This will remain. Now, so therefore, these particular taxes will remain. So these are the major advantages. The advantages which were envisaged or which were expected may not are not likely to be fructified, at least in the initial years of the introduction of GST. That is another unfortunate part of it, because lot of compromises have been made in designing the whole structure of GST. The first major compromise, considering, I may just take a pause here, that as a stockbroking community and financial service community, I presume most of the participants would be from these two sectors. You would equally be interested in knowing that what could be the overall impact on certain sectors overall. So I might be dealing with slightly on a macro aspects, the impact, overall impact. I intend to actually divide the entire talk in 3 parts. The overall general impact, not much, I do not intend to go much into that. The second part is obviously the provisions which are common for everybody, whether manufacturer, service provider, or the trader, which are common, where there is no distinction between your character as a taxpayer. And the third one is the specific impact of the GST related provisions on the stockbroking and financial sector, the issues which are there, major. So, but even specific impact, I would be more concerned with about certain other provisions which are being actually designed and which are going to be implemented. So the first compromise is exclusion of the petroleum products for the time being, which will not be subjected to GST till the date GST Council decides, which can have a telling impact on the ferrous or non-ferrous metal industry, which is the largest consumer, one of the largest consumers of the diesel, etc. Telecom industry, second largest consumer of diesel in the country after railways. Since petroleum products, natural gas, crude, petrol, diesel, and aviation turbine fuel are continued to be levied with the excise and VAT, plus all type of taxes which state government think of in the middle of the night, and which the credit of which will not be available to the user industry, the cascading effect will remain. State government wanted this to be out from the GST altogether, because that actually forms the bulk of their revenue, almost 35%. They didn't want to leave actually this cash cow for them. The actual exclusion is only of alcoholic beverages for human consumption. That is constitutionally kept out the GST regime. The Article 269 12A introduced, which defines goods and services tax under Constitution as goods and services tax means any tax which is to be imposed on the supply of goods or services or both, except alcoholic beverages for human consumption. That is the all beer, vodka, wine and everything, IMFL. So that is complete, so it will be continuing to be subjected to state excise and VAT. In the same manner it is now. We wouldn't be much worried about this. Some people might be concerned with that, but most of we wouldn't be worried about that. And even the person who is enjoying this also wouldn't be worried about this, because once he leaves the pub or bar, he wouldn't be knowing whether the pub owner is charging him income tax or octroi or LBT. So that is besides the point. The other important feature is I talked about CGST and SGST. At the same time, integrated GST, which will be levied on the interstate supply of goods or services, that IGST, it is a constitutional deeming fiction introduced that all import of goods, supply of all goods or services from outside India will be deemed to be interstate supply. Any goods imported from outside India, any services availed from outside India will be deemed to be interstate supply of goods or services. CVD and SAD will be replaced by IGST. So there will be integrated GST which would be levied on the supply of goods and services which is obtained by a taxpayer in India from outside India under goods obviously at the customs gate, basic custom duty plus IGST, and services under reverse charge. We are already under reverse charge at present as far as the import of services are concerned. Similarly, in GST also reverse charge will continue. And that brings us why it happens. GST is a destination-based consumption tax against a origin-based tax like CST. Even service tax today is also a origin-based tax. We have place of provision of supply of services, POPs are, right? Place of provision of services rules, 2012. If you see, they are all more or less based on the destination principle. But since service tax is a central levy, which I mentioned in the beginning itself, the destination principles and the supply rules have no role to play, because I need not determine where I am situated today and where my customer or place of supply today. If a stockbroker is situated in Mumbai, even if his customer is situated anywhere in the country, he charges service tax at the uniform rate in the bill. So that to that extent, in the domestic transactions, these place of supply rules have no role to play in the current service tax regime. This aspect will completely change in GST, because GST is a destination-based tax. So for example, today from a Maharashtra dealer supplying the goods to Gujarat, charging 2% CST against C form, the income accrues to the state of Maharashtra, 2% CST. The very transaction in the same manner if undertaken, when undertaken under GST, the entire income in the form of IGST will accrue to Gujarat. Transaction is the same, but income will go to Gujarat. because it is a destination-based consumption tax, therefore it is essential to determine the place of the destination or the place of consumption, because it is that place where the taxing jurisdiction will come into play, and we will have to decide whether it is an intrastate transaction or whether it is an interstate transaction, which is crucial in the context of destination-based consumption tax. And with these, so two features coming forward. One is destination-based consumption tax, another the basic core feature, and that is value addition. And in this context, the VAT or GST has been defined as that value-added tax is a destination-based consumption tax which is levied on value added at each stage of the economic chain of supply, starting from production till covering entire distribution chain till the final consumption. And all the people who are situated in this economic chain of supply merely act as a tax pass-through, and the tax finally sticks to the final consumption. This is the essential core feature of it. The impact is all B2B and B2C transactions are covered under the GST. Nothing is left. All B2B transactions and all B2C transactions will be covered under GST. But everybody will be, and why this is the feature? As I again said in the beginning, that all consumption, all indirect tax being consumption tax, including GST or VAT, which is to be levied, the primary aim of the VAT or GST is to impose the tax on the household consumption taking place in the country. And the aim is to relieve the businesses of the tax burden. It is to be levied only on the household consumption. Businesses should not suffer the burden of the tax. That is the core philosophy of VAT or GST. And that is to be ensured through the credit mechanism, whereby they simply pay the tax only on value addition, and that also they pass on to the ultimate next buyer of the day who is engaged into the business activity. Since the ultimate consumer is not engaged into the business activity, the tax stops there and he finally bears the burden. So the provision store or the medical situated at the corner of the gully, who is a retailer store, selling the product to the biscuit, Cadbury or medicines, right? He will also supposed to charge GST or VAT to the customer coming to his counter. And there, the burden stops. However, in the present scenario, the customer doesn't know, first of all, how many taxes are actually loaded into the price. One, and he is also paying the taxes in one way or another, which are levied on the taxes at the earlier stages, because of the cascading effect. In GST, the tax will be recovered from him, but in the previous stages, it will be only on a value addition. To that extent, it can lead to the reasonable pricing of the product or services, which is not ensured in the current scenario, in the current regime. So, this destination-based consumption tax, and the other impact of this will be with the coverage of all B2B and B2C transactions. Because of that, what will happen is the revenue is expected to surpass the wildest imagination of the government. And that has happened. That has happened. In fact, sometimes I feel amused when we talk about the loss on account of the GST by the states. If on one side we are talking about an increase in the GDP to the extent of about almost 2%, and now with the latest projection coming to 4.5%, 6.5 lakh crore increase in the GDP in the monetary terms, where is the question of loss of revenue for the states? Is it a eyewash? Appears to be so. Just to another reason to levy compensation cess. So, where is the question of? But then it has always surpassed. With the swelling coffers of the government, in the coming years, one can expect a reduction in the income tax rates. In fact, Netherlands, Sweden, New Zealand, and such countries have introduced GST with a primary aim to reduce the rates of income tax. World over, there is a change shifting in the policy of the government, who have to collect the revenue to carry on with their welfare policies. And that revenue is collected in the form of direct tax and indirect tax. But world over, the emphasis is now being put on more on indirect tax rather than the direct tax. There's a clear shifting of this policy. And in GST regime, because with the all B2B transaction and B2C transactions coming under the GST fold, the parallel economy or the cash-driven sectors of the economy, you can call it cash-driven, unorganized, black market or whatever we want to, are likely to come on records, which also are able to escape the income tax net because they are escaping the indirect tax net, which is levied at the inception of the transaction. Income tax comes after the closure of the transaction. They are likely to come up on the records. And with that, there could be a tremendous increase in the revenue, multiplier impact of that, as I call it, which would enable the government of the day to reduce the income tax rates also in the coming years. So this would be the overall impact. With this background, keeping this background in the mind, let us now get into the certain important aspects of this entire GST structure. I would be covering certain part of supply, registration, returns, input tax credit, the invoice matching provisions, reverse charge mechanism, transitional provision, whatever relevant are there, and mainly the place of supply in the context of stockbroking, the current issues relating to the transaction charges, demat charges, recovery of that, plus whether centralized registration. These are the certain main features, because we are now at the stage where there is no need for me to go into any interpretational exercise whatsoever. I mainly try to cover mainly the operational or functional aspects of yours. What are the issues? What issues can still remain? I will be on that. So let us. And now, while I'm beginning, I know I just might be opening the Pandora's box. So, but maybe I'm absolutely helpless not to open that. So maybe on Pandora's box at the end of the session, something on Pandora's box. The first and important thing here is today the taxable event, for any levy of the tax, it is mandatory to have the taxable event. Today, what is the taxable event for excise? It is manufacture of the goods. For sale tax or VAT, it is the transfer of title in goods for a consideration. And for service tax, it is the provision of taxable service. These are the three taxable events laid down under the Excise Act, Central Excise Act 1944, Finance Act 1994, and VAT Act of 2005 and others of the state wide laws. Overnight GST, the taxable event will be the supply of goods or services or both. So the terms of manufacturers, VAT or service, provision of service, with which we are so much accustomed to for all these years and decades, will all become the history. We will have to replace it by supply. We will have to understand ourselves as a supplier of the goods or services. And in GST, there is no distinction between a supplier, whether he is a manufacturer, whether he is a service provider, or whether he is a trader. All are at par. All are supplier. So from 1st July, all of us will have to consciously start thinking ourselves in the name of, as a supplier. We are supplier. And it is right that the supply has been termed as a taxable event under GST, because as there is an anonymous quote says that the government works on, as far as the tax collection, tax part is concerned, government always works on the principle of demand and supply. Government demands and we supply in the form of. So supply, and this supply is defined under Section 7 of the GST Act, CGST Act. We are now aware about that CGST Act, IGST Act, Compensation Act and UTGST Act have all been passed by Rajya Sabha. 12th April they have been enacted. The date of notifying it, that is the date of taking effect, will be notified soon. It can be 1st July or whatever it may be. So far it has not been notified. State GSTs are under consideration. They are likely to be mirror image of the each and CGST only with the grammatical correction. Telangana has already passed on Sunday 6th April in an emergency session. Telangana has become the first state to pass the state GST law, which is the mirror image of the CGST Act. So at least probably we can look forward to some sort of a uniformity of the state GST law, unlike the today's weight laws among the states. We can, but you never know. If we are dealing with more than one state, every state GST law, for once it will have to be gone through with the fine tooth comb. Because what mischiefs they might have done as far as their state GST, particular state GST law, we never know that. So we cannot take it granted. We are only presuming, we are only hoping for it will be a mirror image of CGST. That is what. And with that, the stage will be paved for. So supply is defined. And supply has been defined in an inclusive form. Please keep it in mind. Supply includes all forms of supply, such as sale, disposal, license, rental, barter, exchange, leasing, all such other forms of supply for a consideration which are undertaken or agreed to be undertaken in the course or furtherance of business. So all forms of supply, this is an inclusive definition. So if something is left out, but if it has a connotation or characteristic of supply, it will still be covered. But it should be for a consideration. So free supply is out, subject to certain exceptions. Free supply is not part of the GST. Cannot be levied to GST. And third, should be in the course or furtherance of business. And so non-business activity, if there is any supply, subject to certain exception, it is not to be levied to GST. Now, business itself has been defined in a very exhaustive manner, whereby whether it is for a pecuniary benefit or not, irrespective of volume, frequency, continuity or regularity of the transaction, it will still be considered as a GST, as a business. There is a long winding definition of business, whereby the Supreme Court ruling in the Ahmad Bakshi's case, that a business pre-notes is a term of indefinite import, but basically it is an activity, profession or vocation which is carried out with an intended pecuniary benefit. The business definition here says whether or not for pecuniary benefit. In a Raipur Manufacturing Company, Supreme Court says that it is the volume, frequency, continuity or regularity of the transactions along with the intended pecuniary benefit which determines whether the activity is a business or not. Here it says irrespective of the volume, frequency, regularity or continuity. So there is a dilution of all these principles, but again we will not go into that. Just for that, supply is so widely worded, business is so widely worded, that one has to be careful whether the particular transaction has a connotation of supply or not, particularly when there is a consideration involved. This one. The second, it says import of services for a consideration whether or not in the course or furtherance of business. If anything is imported from outside India for a consideration, even if it is for the personal use, then also it is treated as a taxable supply. So if you download any applications or anything for which the direct payment through credit card or something is made, even it is for your personal use, then also it is a taxable supply. We have to be careful what our children are doing, because generally we come to know about their mischiefs when the credit card bill comes. How this is going to be implemented, we don't know, but we are expecting that some monetary limit of exemption will be provided, whereby such services which are imported from through Google or other applications for a consideration for personal use will be exempted. We'll have to wait for the notification, but very, very dangerous sweeping provision. Then there are deemed taxable supply where there is no consideration, still it will be treated as a supply. And these are all listed in Schedule 1 of the CGST Act, where these are deemed to be taxable supply even if there is no consideration. Permanent transfer or disposal of a business asset on which input tax credit is taken. Now, on which input tax credit is taken, I can only envisage for the time being that there cannot be a separate consideration for a business asset if it is a part of the slum cell. But if I have taken the input credit, and if it is sold as a part of the permanent, the slum cell, there could be a issue about my taxability. The second one is transactions between related persons or the deemed distinct persons. There is a provision for section 25 under two distinct person, and establishment of a person in India or establishment of the same person outside India are deemed to be related persons, are distinct persons. If two people are holding two independent registration in the same state, then any transaction between these two registrations will be treated as a distinct person. This can happen under GST when there are two business verticals for which voluntarily the person has opted for the registration. It is allowed, but this is voluntary, optional. Business verticals has a connotation as per the accounting standard 17. We know segmentation reporting. We are aware of that. So these business verticals, if a company with the same PAN number, all GST number will be PAN number. If you don't have PAN number, no GST registration. And if you are not having GST registration, you are just like an orphan child under GST. So if the entity has a two business vertical for which it opts for the separate registration within the state only, then between any transaction between these two will be treated as a transaction between two distinct persons. Employer and employee are treated as related persons. So as such, any transaction between them are the transaction between related persons. The other part is two establishments of an entity in two separate states, independent states, duly registered, any transaction between them are deemed to be between two distinct persons. So if an entity registered in Maharashtra and having its another registration for the branch or anything in Gujarat, any transaction between these two will be treated as a transaction between two distinct persons. And between such deemed distinct persons, artificial distinct persons, if any transaction takes place, even without consideration, it will be treated as a deemed supply, and therefore valuation of it on a notional basis will have to be arrived at in terms of the valuation principles, artificially. In the context of goods, you will understand that now with the GST coming in, branch transfer, stock transfer will all become taxable, which will have a huge impact on the FMCG companies, all pharma companies who generally operate through the branch transfer. Everybody will have to revisit their warehousing policy, which they have already done. They are doing it, because now there is no need to, or it may not be viable to open up the branches or stockyard or set up warehouses in different states just to maintain the parity in the prices. With the uniform tax structure expected at least in the initial period under GST for the product and services throughout the country, it may not make sense to have warehouses or the branches in every country, every state of the state. Instead, the warehouses or branch may, if at all necessary, it will be a complete consolidation of the warehousing policy, and the warehouse can be set up by the company maybe at some strategic place like Hingna, Nagpur, that's why coming up as a major warehousing hub of the country, being in the center, which can cater to the different states nearby. So this will have this type of impact, and that's why logistics companies, those who are into logistics and warehousing, they are probably the favorite players in the market once the GST ushers in, for the right reason. It can have a huge impact on the transportation cost and logistic and everything. Positive impact I am talking about. It is expected that today 1 rupees 25 paisa per kg per kilometer, which is the transportation cost, may come down to 70 paisa with the introduction of GST. And if the road check nakas and everything is removed, and if smooth flow is allowed, which probably is already being hampered, then probably the cost can even come down to 40 paisa per kg per kilometer. Because everything is going into bribes and everything. This is from the logistic transportation perspective. So now coming to, so therefore this between these distinct persons, this is taxable. So employer-employee are related person. However, any services from employee to employer is treated as a non-taxable supply under Schedule 3. So one need not worry about that. Today also it is excluded under Section 65B 44 service definition by way of an explanation. However, if the employer gives any gift to his employee of a value of more than 50,000 rupees, then it will be subjected to GST. So if you gift your employee, if a company gives his employee for a sterling performance or during Diwali or Dasera, any gift which is beyond 50,000 rupees valued at, then GST will be payable on it. If it is below 50,000, then credit will have to be reversed. But if it is above 50,000, probably the Q might have been taken from the Sri Hare Krishna Diamonds and Savani, who had actually gifted the, the small Maruti cars and houses and all that. So whatever may be the justification, but yes, this is something which will have to be kept in mind. The other aspect is principal and agent. Principal and agent are never treated as two independent people. Obviously, vicarious liability. The very fact that there is an agency relationship. In GST, any transactions between principal and agent will be treated as a transaction between two independent people. And therefore, when a clearing or forwarding agent or a consignment agent sells the goods on behalf of the principal supplying the goods to him will be treated as a taxable supply. He will have to pay GST on it. Agent will have to take a credit on it and then sell it on behalf of the principal. His income will be only commission or brokerage, but still the supply. This can completely annul the entire principal agency relationship, because for accounting purpose, income tax purpose, he is still an agent, but for GST purpose, he is an independent buyer of the goods. This can have some catastrophic effect on the principal agency relationship, particularly in the industry like pharma, which operates through the consignment agent principle. This one. So these are the deemed supply. Then Schedule 3 talks about non-taxable supply. Schedule 2 speaks about certain activities where artificially it is declared whether this is a supply of goods or supply of service. For instance, the financial lease has been declared as a supply of service. Under Schedule 2, all financial lease will be as a supply of service. Works contract service, which has been plaguing and troubling the infrastructure and construction sector for all these 40-50 years, has been declared as a supply of service. Any works contract, Section 2, subsection 119 defines what is works contract. Works contract which obviously involves in relation to movable, immovable property, which includes the supply of labor and supply of goods in which transfer of property takes place. This has been declared as a supply of service. So now only one tax on this type of composite transaction. Only one tax. Right? Up till now, it is a overlapping of VAT and service tax. But in keeping with the international adage, the all EPC contracts and works contract service are declared as a supply of service. The restaurant, the supply of food or beverages for human consumption at the place of, that has been declared as a supply of service also. This will bring at least some respite and clarity. There are other issues which I will not be going into, but these are certain, how the whole structure is taking place. Schedule 2 is also important when we have to determine that whether particular activity falls under that any of these Schedule 2 activities, because it has been artificially declared as a supply of goods or supply of service. The prima facie, one may find that this is a supply of goods, but it might have been declared as a supply of service. So that's why it is very important. Coming to the next part is there are two other important terms which need to be kept in mind, because every now and then there could be some issues on this, and this is composite supply and mixed supply. So what is composite supply? It is a supply of two or more goods or services or combination of both, where one of them is a principal supply and other are merely incidental or ancillary to the principal supply. The example which explains this is that when a person is supplying the goods, at that stage, the buyer, it is a X works. So therefore, transportation, transit insurance, everything is on the buyer's account. However, the buyer requests the supplier to arrange for the transportation to be reimbursed by him, arrange for the transit insurance to be reimbursed by him, for some special packing to be reimbursed by him. This is a combination of goods plus 3 services: transportation, transit insurance, and packing. However, this is a composite supply for the reason that supply of goods is the principal character of the transaction. Buyer is not interested into transportation, transit or packing per se. He only wants the safe delivery of the goods. So this is a composite supply. Once this is a composite supply, then it will be treated as a supply of goods in spite of 3 services being included into it. So it is a supply of goods. This is important because the taxability will depend upon whether it is a composite supply or whether it is a mixed supply. And what is mixed supply? Mixed supply is one which is not a composite supply, but still which is a combination of 2 or more independent supplies of goods or services, or a combination of both for a lump sum consideration. Explained by an example, if a company orders for the Diwali gift for its customers a gift box, which contains dry fruits, which contains chocolates, which contains cookies, and which contains, say, anything else also. Now this is a mixed supply because all 3 are dry fruit, cookies, Cadbury's, biscuits. These are all independent supplies by themselves. They are not naturally bundled together. Right? They are all independent supplies. This is a mixed supply. Now, if there is a composite supply as defined and explained in law, then the liability of GST will be on the basis of the principal supply. So in the given example, it is supply of goods. Even though transportation and insurance is there, still it will be treated as a supply of goods. And GST will be payable as if it is a supply of goods, without bifurcating anything into that. But if it is a mixed supply, then the item which carries the highest rate will be applicable to the entire pack. So if you are mixing cookies, Cadbury's and the dry fruit in a gift pack, in a Diwali gift pack, then the entire gift pack will be subjected to the levy of GST at the rate applicable to dry fruit. Coming Diwali, be careful. And this is important, overall important. Now, I'll come straight to the next part, and that is registration part. The registration will be required by a person who has exceeded the threshold. Threshold is 20 lakh. Threshold is 20 lakhs in all the states except northeastern states and the hilly states of Sikkim. And there it is 10 lakhs. This 20 lakhs is an aggregate turnover. Aggregate turnover has been defined as including all taxable supplies, exempt supplies, non-taxable supplies, interstate supplies, including exports. The sum total of this is an aggregate turnover. This is in stark contrast with the current scheme of small-scale exemption, where 1.5 crore exemption for manufacturer does not include trading activity, does not include exports through merchant exporter or direct exports, and the 10 lakh exemption under service tax does not include the non-taxable services or exports. Here, everything is to be reckoned for the purpose of aggregate turnover of 20 lakhs. Exempt supplies means exempt which is exempt under a notification. Section 11, central government has power to notify any goods or services the supply of which should be exempted, and also includes non-taxable supply. Now, this is to be again kept in mind with section 9 subsection 5, which says exempt supply, section 17 subsection 5. There is a very important aspect here, that today exempt supply includes non-taxable supply, which is again is not the scheme of the things under the threshold exemption in the current regime. And what it says, there was some apprehension that goods has been defined as a goods means any movable property, including actionable claims and security. That has now been taken care of. So we need not worry about securities have been governed under goods, and securities is service also. That anomaly which I had pointed out in June, that has been taken care of in November, and now it is no longer there. So securities are outside the purview. The point is, what has been left out is, service is defined as services means anything other than goods. If service means anything other than goods, and immovable property is not goods, will it be taxed as a service? That was the apprehension, according to me, totally unfounded apprehension, that was conveyed to the government. So government sprang into action. So under Schedule 3, now sale of land, sale of building unless under construction building. Under construction are subjected to service tax and works contract tax even today. That will continue even under GST regime with the occupation certificate, prior to occupation certificate and after occupation certificate. But sale of building per se, so complete unit, we will treat it, complete building. So sale of building, sale of land, trading in securities, these are treated as declared as a non-taxable supply. These are non-taxable supply. So far so good. But exempt supply includes non-taxable supply. This is further made clear in the context of proportionate reversal of credit, where it is clearly provided that for the purpose of proportionate credit reversal, exempt supply shall include sale of land, sale of building other than under construction, trading in securities, and supply on which tax is payable under reverse charge mechanism. Now, what happens is, if let us assume a taxpayer in his individual capacity is engaged into taxable supply of whatsoever nature, as a stockbroker or otherwise, the very stockbroker has also got some ancestral property in native, which is in his name. He is discharging his GST liability in his stockbroking activity or any other activity, PMS or whatever. It can be anything. Even I can come under this, advocate, chartered accountant, whatever. And he sells his land, which is there in native, which is in his name. The sale of land is a non-taxable supply. Because it is a non-taxable supply, it will be considered as an exempt supply. So at that particular point of time, this person will be considered as being engaged into two activity, taxable supply and sale of land, non-taxable supply, which is exempt supply. So whatever credit he takes, he will have to proportionately divide it. Because sale of land will reflect into his balance sheet, income tax return. The nexus, there is absolutely no nexus with his procurement of the input and input services on which he is taking the credit. That has nothing to do with his sale of land. It is a passive transaction as such. Still, it is an exempt supply. Therefore, he will have to account for, so whichever credit which cannot be attributed to which is common in nature, suppose that proprietary concern, he is availing the services of the auditor. So the auditor will charge him in his proprietary concern and not activity wise, on which auditor will charge him GST credit, CGST, SGST or whatever. He will take the credit of that, but this credit cannot be related to his taxable or sale of land, because sale of land is also getting, that entire land sale is getting reflected into the balance sheet, which is a part of his audited annual accounts. Then it is an exempt supply and it is a taxable supply. You have to proportionately divide this. This is the impact of this. Sale of building. We don't know today whether the flat in the building will be treated as an exempt supply or whether it will be liable to or not. Because they say sale of building, Deepak bhai, it does not say sale of part in the building. Today, if I sell my residential flat or my commercial flat, am I supposed to pay GST? As of now, we have no answer to this. Does not appear to be the intention, because these are all totally out, but today I would not vouch for that. As such, if I go by the plain interpretation of the law, right? The registration, so aggregate turnover and exempt supply, there is a tremendous scope of this. We'll have to keep it in mind. Coming to the other part of, and that is the input tax credit, which is the core feature. I started from cascading effect of tax on tax. So input tax credit is available on all. The words used are input tax credit, means the taxes in the form of CGST, SGST, IGST charged on as an input tax on any supply of goods or services. So credit of only 3 GST will be available: CGST, SGST and IGST. All other taxes which might be paid or payable, no credit of that will be available. In whatever form, for whatever purpose it is paid, credit will not be available of that. Only credit of CGST, SGST and IGST will be available, provided these goods or services, including capital goods, are used or intended to be used for the business. At least this intended to be used phrase brings some consolation because it is a much wider and clear term than the current phraseology which is used in the context of capital goods rule 2A Senvet credit rules, input rule 2K and input service rule 2L, in or in relation to the manufacture of the final product or for the provision of service, etc., etc. Now it is intended to be used. So that is available. Capital goods is important. Capital goods is for the first time defined in a very pragmatic and prudent manner. Right now, the capital goods definition under Senvet credit is by the chapters or description or headings, right? However, under GST regime, capital goods has been defined as capital goods means any goods, the value of which is capitalized in the books of account. This is a very pragmatic definition, which is capitalized in the books of account. So that definition has to be kept in mind. Coming to the input tax credit, everything is available, barring motor vehicles and conveyance, even if it is used for the business purpose, no credit. Food, beverages, outdoor catering, health services, cosmetic and beauty parlor, unless they are falling under the same category, no credit. Anything for personal consumption, no credit. These are all restrictions which are continuing right now also. And any goods which are lost or stolen or destroyed or written off or given by gift or sample, credit has to be reversed, no credit on that. You will have to maintain the records of that. Coming to the utilization of credit, here again one has to be careful. So first, when you take the credit, one has to see whether it falls within the four corners of the allowed, the goods or services eligible under section 16. Section 16 provides for, okay, on which credit will be available and what credit will not be available. What are the four conditions for taking the credit? Please understand, friends, GST is going to impact your cash flow in a huge manner, because every person is expected to come under the tax net and charge you GST. For you, for a company taxpayer, it becomes imperative that all the transactions of procurement are correctly captured so that not a single paisa credit is lost, because that will probably will define your profit element. It can have a bearing on your profit element. Whatever is lost is lost. Now, the four conditions: goods and services shall have been received. One, invoice should have been there, prescribed invoice should have been there. Third, credit will be available only if the supply on which the credit has been taken, that tax has been paid by the supplier. Please bear in mind, if the supplier doesn't pay the tax, the buyer will not be entitled for the credit. This can have again, so one will not only have to ensure the compliance of his own, but he will have to see that all his suppliers are basically complying with the law. And this law has been worded in such a manner that if a supplier at the end of the month in his return has declared a 1 lakh rupees of liability for 10 supplies made to 10 different people, out of which a particular taxpayer has actually availed 15,000 rupees credit for his supply, and that supplier pays 99,000 rupees, does not pay 1,000 rupees, entire credit of 1 lakh will be disallowed to all the 10 buyers. This has its roots because of the mass scale invoice scam which were unearthed in the recent past, which Deepak Bhai is all aware of that bogus invoice and supplies and fictitious invoice and all that. But I know the untold misery it will inflict upon everybody, but there is no respite, because this was the first condition of the states, that if you go ahead with the GST, we want these provisions to be made. So you'll have to continuously ensure, and this has resulted into almost all the large and the major companies resorting to the vendor sanitization process. ABC analysis. I will deal with A, I will keep a watch on B, and I will not deal with C. There are letters and letters which are now flying. Okay, tell us your HSN code number, tell us your migration code number, tell us your percentage of cost, what have you done, what records are you maintaining. They are poking their nose into the other's business completely. So much so, today I saw a letter whereby a major buyer to my client has asked even what is the percentage of our cost, material cost, and complete costing he is asking for. whether rightly or justifiably or not, but that apart. But this is important, we have to live with this. Coupled with this, there is a matching of the invoice. This matching of the invoice concept, which is right now in goods under J1, J2 form, that has been in actually introduced in full-fledged manner in GST. And this I will not go, it is complete technical, there is no need for me to go into detail. Suffice to say that every single person who is registered in a state will be required to file only 36 returns per year. 3 returns per month, 1 annual return, so coupled with that 37 returns. 36 compulsory plus annual return in the next year. These are compulsory per registration, per state. On 10th, outward supply, on 15th, inward supply, on 20th, monthly return. This is compulsory. If you are holding input service distributor, then another 12 return by 13th every month. For a people who are under composite levy, it will be 18th on a quarterly basis. Then there is an electronic commerce operator who are supposed to file the return separately for their TCS, tax collected at source. There are certain specified notified supplies up to a value of more than 2.5 lakh, which government may prescribe under section 51, where there will be a TDS of 1%, for which there is a separate return. Then non-casual casual taxable person, non-resident taxable person, separate return. So these are all independent returns which happen mainly for our purpose. 37 returns per registration for an entity per registration. Again, I am repeating. So if you have registration in 10 states, only 370 returns per year, which are required to be filed. And the last condition is, fourth condition is, the taxpayer should have furnished the return in terms of section 39. Any delay in the return will result into probably defeating your claim. I read this condition as applicable to the taxpayer, that is recipient, and not to the supplier. According to me, this applies to, so it means the recipient also will have to file the return in time. Friends, registration and returns, no compromise on that. No delay, nothing. You will have to take it very strict view that I will have to comply with the law within time as per law. Whether my non-obtaining registration or delay in obtaining registration or delay in filing the return is a condonable lapse or procedural lapse, etc., please do not enter into that. The current rulings and the principle laid down how far they will be applicable in GST region, it is not worth trying also. If you have to comply, you have to comply with the law from the day one. So these requirements of coupled with the invoice matching, every credit which the taxpayer will be taking is a provisional credit for 1 month and 45 days approximately. And thereafter it will get assessed finally. Everything will be on the GST portal. Everything automated. It is said that GST and network is expected, is geared up to handle 3 billion invoices per month. 3 billion invoices per month. However, whether the taxpayers of the country are geared up to get into automating mode or digital mode or not is a question. I don't know whether there will be complete chakka jam beyond 1st July. And how many of the taxpayers will be able to file the returns for the month of July. There is a huge challenge. Your complete front-end operations and back-end operations will have to be revamped. And all the capturing of your transaction will have to be real-time. We are all aware about RTGS, real-time gross settlement. It will be a real-time invoice capturing, complete. There is no escape from this. It will have to be done. Coming to the utilization of the credit, 3 aspects, the 3 credit which will be available is, the first is CGST, SGST and IGST. Now, CGST and SGST will be on the intrastate supply, and IGST will be on the interstate supply from outside the state. This credit will be available. How it is to be utilized? CGST only for CGST and thereafter for IGST. SGST only for SGST and thereafter for IGST. IGST first for IGST, thereafter for CGST, and thereafter for SGST. This order will have to be maintained mandatorily. No compromise in this order. Any mistake in this will result into the wrong utilization of credit, leading to the short payment of tax plus demand and recovery. I'll repeat, CGST for CGST first, and thereafter for IGST. CGST cannot be utilized for state GST. State GST for state GST, and thereafter for IGST. State GST cannot be utilized for CGST. And IGST for IGST first, thereafter for CGST, and thereafter for SGST. And there is a reason for this, because under destination-based consumption tax, when a person, taxpayer based in Maharashtra, when he utilizes any SGST credit for IGST, Maharashtra will compensate the center clearing house, and that credit will be available to the recipient and in Gujarat, and when he utilizes the IGST for SGST payment, center will compensate Gujarat. So this is how the tax will flow from Maharashtra to Gujarat, and that's why there is a strict mandate for utilizing this credit in this particular order, which will have to be maintained, records and everything. So this is for the utilization part. Coming to the valuation principles, section 15 contains the valuation principles which are largely patterned on the customs valuation rule, rule 2.2. Mainly, they have brought into the custom valuation procedures. I will not go into that. 3 other side aspects but which are important, and then I'll come to the certain specific issues. The 3 are, the one is mainly for manufacturing industry, and that is e-way bill. We thought that e-permit and everything is a case of the past. Unfortunately, it is not so. Any consignment leaving the party for beyond 50,000 rupees will be subjected to the, he will have to take out the e-way bill, which is from the portal, will have to be uploaded on portal. The buyer will actually confirm, and then there is a e-way bill distance. E-way bill validity will be the 100 kilometers 1 day, 200 kilometers 2 days, 300 kilometers 3 days, etc., etc. So if the distance between the two places is suppose 500, and the goods are received after 8 days, and the mobile squad before whom this EV bill is presented, he may ask, why 8 days? You should have come back. It is only 5 days and 500 kilometers. So the fellow will have to explain that there were a lot of diversions and I was coming through the villages and all that thing. What type of laws we are making, we don't know that. The second is important, and that is reverse charge mechanism. Reverse charge mechanism will continue to be applicable for the import of services. On goods, IGST will be applicable apart from BCD, and all your import of services from outside India for whatsoever purpose, IGST will be leviable. Today service tax is leviable. So IGST will be whatever it may be. IGST is the sum total of CGST and SGST. So whether it is 12% or 18%, it will be leviable. Only thing is, today CST is not available by way of a credit. IGST will be available as a credit, full credit. However, that will remain in the books of accounts till your output tax liability arises. So with the all sorts of vendors charging the recipient or the buyers of the goods and services, almost all will be charging, because this, I personally feel, composite levy and 20 lakh exemption. Composite levy is not applicable to service providers except restaurants, so I am not going into that. But with composite levy and the threshold exemption, practically on a paper, it is basically an eyewash according to me. And therefore, practically every single vendor of yours, of the taxpayer, will be charging him GST. Credit will be available subject to restrictions, including interstate procurement of the goods or services, but it will only be utilizable when the output tax liability arises. Till that time, it will not be. This can have a huge impact on the cash flow. It is expected the working capital requirement practically of every business organization of whatsoever character and nature is likely to go up substantially in the initial years once the GST comes in picture. That is. The second impact, reverse charges, and this is dangerous. Section 17 subsection 4. Section 7 subsection 4 of UTGST Act. Section 5 subsection 4 of IGST Act And similar will be in SGST, section 9 subsection 4 and section 9 subsection 4, sorry, CGST Act. It says if a registered person procures any supply of goods or services from an unregistered person, then that registered person will have to discharge the GST liability under reverse charge. And this is applicable to all. Unlike other reverse charge mechanism where it will be notified. So it can be GTA, it can be advocate service, we are under reverse charge right now. It can be import will be there. Import obviously because it is a destination based principle. Therefore exports will be totally outside the GST levy and imports will be under GST levy because place of consumption in import is in country, place of consumption in export is outside the country. So that is understandable. But apart from that, it may be extended to some other sectors as is presently done. However, we have gone beyond this. Any procurement from unregistered person of goods and services with no notified, nothing specified, nothing. The impact of this is if I come to your premises for some consultation, for some conference, and you order some South Indian food or juices from outside for me, from a person who is not registered under the law, and if you put that voucher as a business expenditure in your books of account, first you will have to pay GST on it, on that juices and sandwiches and South Indian dosas and everything. And after paying it, you can take the credit, that's a different matter, but you will have to pay it in cash. Because all reverse charge liability has to be discharged in cash. Credit cannot be utilized for that. So there, yes, I'm coming to that. So you will have to, this is one single provision which can undo everything. Every single expense which you are booking into the books of account will involve some sort of supply of goods or services. I have given you an extreme example. But even if you procure your supply from the unregistered person, like a person availing the 20 lakh exemption, under reverse charge, the recipient will have to pay tax. Now one can imagine the impact if the sub-broker is exempted up to 20 lakh, the tax on it will have to be paid by the main broker under reverse charge. And then credit will be available. In VAT terms, we call it as a URD purchase. But they have taken it in a different stratosphere altogether. And there are specific columns in the returns for declaring such type of transactions of procurement of supplies from the unregistered persons. Whether it is impractical, irrational, absurd, nothing, the law. We can only hope for it will, at least this provision will not be notified. Along with all the entire act, we can only hope for this. Otherwise, I don't know what will happen. Because this practically renders the entire threshold exemption totally nugatory and redundant, because if a person is not evading the tax, if the person is availing the threshold exemption, on that also if the buyer or recipient will have to pay the tax under reverse charge, either the person will not do the business with that fellow, or he will compel that person to come under the tax net. And let me tell you, Sophie, three intentions of the government. The first is they want to bring the financial discipline in the country. One, they want everybody to come under the credit net because it operates through credit principle. And third, the question of coming under credit net would arise if I am under the tax net. Because if I am under the tax net, don't only I will be entitled for the credit. That's why I said exemptions are the things of the past now. Laudable intentions, but are we ripe for this? Is this the way to go about it? A path to hell is always loaded with the good intentions. So, but you will have to be on your guard. Be careful on this. With these certain specific issues of concerning the stockbroking, etc., first and foremost, the first question on the mind of everybody is whether a broking house or a finance company having operations in number of states will be required to take separate registration or not. centralized registration is not expected to be allowed. There is no way, if a taxable supply is made from different states, compulsory registration will be required. This. Last week I was at Madras Chamber of Commerce, where one of the senior most officer of the government, who is presently holding the post of commissioner in Chennai, he inaugurated, and in half an hour he very well summed up the whole GST philosophy. He said that we are aware of the problems of banking industry. There were a lot of queries from banking and insurance and other companies. He said we are aware of, but we are also conscious of the fact that if we allow one sector, we will have to allow to every sector. And their idea is not, because they feel that this entire centralized registration concept will not work in the destination-based principle, because where the consumption takes place, the state will not get the revenue. So they will not allow. I would be mentally be prepared that I will have to deal with the multiple registrations. If I have operations in multi, I am not required to take the registration in different states because my customers are situated in the different states. Please understand that. I am required to take the registration in different states if I am making the taxable supply from the different states. Not because my customers are situated in the different states. Please keep it that in mind, number one. The second is, what happens if a main broker has a terminal, say in Ahmedabad and Delhi. Either the terminal would be operated by him under his own entity, or he would have, actually it is operated through the sub-broker. The terminal is operated through the sub-broker. Then what will happen? Now, the Ahmedabad terminal is operated and it is being catered to, the services are provided to investors are based in Ahmedabad, mainly in Gujarat. Do I require, but head office is in Mumbai. Contract note is issued from Mumbai. Whether this is a IGST transaction or whether this is a SGST local transaction, to put it simply. Because place of supply, under place of supply rules for services under GST, in case of stockbroking, finance and banking industry, is the place of the recipient of the service, which is the address of the recipient, which is on the records of the supplier, and where such address is not available, then the location of the supplier. So address is available. He is in Ahmedabad, he is the investor, right? And you are undertaking, stockbroker is undertaking the trading in security for the, through his terminal in Ahmedabad. But terminal is in his own account. This terminal is attached to the main server in Mumbai. Then what will happen? Two issues can arise. These are all critical issues. I am only voicing my views. Please understand. We will also have to wait for lot many other things, some clarity, because on the sideline, on 17th and 18th May, there is a next GST Council meeting in Srinagar, where they will be mostly giving the final touches to all the draft rules, plus deciding about the bracketing of the goods under 5 slabs, 0%, 5%, 12%, and 28% subject to maximum 40%, and service rate, which I am expecting 2 slabs, 18% and 12%. I am expecting 2 slabs of service tax, the services rate under GST. So they will be finalizing that. Now, in that case, the one is, it is attached to my main server in Mumbai, and I am issuing the contract note. Therefore, it is an interstate transaction, because the buyer is in Ahmedabad, so it is IGST transaction. However, the terminal is based in Ahmedabad in Gujarat, and the place of supply is Gujarat, place of consumption is Gujarat. The services is provided from Gujarat because the terminal is situated there. The entire trading transaction in safes actually takes place in Gujarat, through Gujarat. Therefore, it is. In that case, as per the place of supply provisions, if there are 2 establishments with which the service is supply is connected, then the establishment which is most directly connected with the supply shall be taken. So it is Ahmedabad. Therefore, it is Gujarat. So even though I am issuing the contract note, I cannot charge IGST. I will have to take registration in Gujarat, and in my contract note, I will have to charge him CGST as GST. And any expenses in relation to that terminal, that my operational establishment, if I can take the credit over there, that is a different matter, but 2 registration will be required. What happens if the terminal is operated, given to the sub-broker? Then he is acting as my agent. However, the principal agent, why I mentioned about that for a specific reason, that principal agent to be treated as a supplier to each other, that is applicable only to goods and not to services. There is no agency relationship recognized as an independent for supply of services. So he is my agent. I am giving in the terminal, and that as a sub-broker, but as a sub-broker, SEBI guideline says he cannot issue contract note. So as far as his brokerage is concerned, the sub-broker will be issuing his invoice. Now it is compulsory. And interstate supplies are not entitled for the threshold exemption. If a person is engaged into interstate supply, 20 lakh exemption is not available. So he will issue his invoice on me, charging on a main sub-broker the IGST, of which credit will be available to main broker. However, as far as the main broker concerned, who is issuing the contract note in the name of the customer, there it will be the recipient location, because he has entered into this transaction not himself but through his agent, and therefore it is Mumbai to Ahmedabad, and therefore it will be IGST. So if the terminal is operated by the main broker himself in another state, then it will be a local transaction for the investor situated in locally. If it is operated through sub-broker and the contract note is issued from Mumbai, then it will be a IGST transaction. This is one. Other certain areas will be about the demat charges, SEBI charges, transaction charges, turnover taxes, that is stamp duty, what will happen to them. Section 15, subsection 2, valuation principle says that value shall include all duties, cesses, fees and charges leviable for the time being in any law which is in force except GST related laws. So if you pay CGST, SGST or IGST on anything, that will not form part of the value. Any other tax which is paid should form part of the value. There is a clear mandate of that, which is levied for the time being on any law which is in force. If we go by this, then the question arises whether the stamp duty, demat charges, turnover taxes which are recovered, if at all it are recoverable, but there is a whole sort of controversy going on right now. So therefore, whether it will form part of the value or not. Two ways of looking at it. A plain reading says it is recovered as a part of the consideration, though it is at actuals. If there is a margin, there is a difficulty. Definitely today also. But if it is at actuals, then it is not, it is recovered as a part of consideration, but it is a pure reimbursement. So therefore, the first argument which can be is that these are all issues, because in the Religer securities and LSE securities, these charges have been held to be not liable to service tax, because it is not part of the commission or brokerage. And today the service tax is on commission or brokerage. But GST law does not speak about commission or brokerage. It only says consideration, and consideration has been defined in a very detailed manner. Today we have no definition of consideration under service tax law. But GST defines consideration in a different manner, which is different than section 2 subsection 24 of Contract Act, which is made applicable under today's service tax law. So now this will be, assuming this is, the first question is whether these are the taxes or charges leviable on SEBI fees, which are leviable on the security per se, or whether it is leviable on my brokerage or commission, which is my consideration. If it is on security per se, then these are not non-taxable supply under Schedule 3. If it is considered as levied on securities, then it can be a part of the value of securities. And since securities per se, in trading in securities, I am supplying the securities through my agent, and therefore it is not liable to tax at all, because Schedule 3 says trading in securities is a non-taxable supply. This is one way of, this is a dicey argument, I would say. The other plausible and reasonable argument would be, or safe argument will be, if I am recovering it as a part of the reimbursement at actual, then the present pure agent concept of Rule 5 under valuation rules still continues under GST law. So obviously, I am acting as an agent for my investor when I am undertaking trading in securities. Therefore, it will be much more safer to claim it as a pure agent reimbursement and therefore excluded from the value, taxable value under GST. But there could be some fireworks on this particular aspect. The other point is about the CBLO, the CLBO, that is a collateral and lending borrower's obligation. Department has been trying to levy service tax by saying that this is not in the nature of interest, right? So taxable event is not nature of interest, it is the purchase of security, purchase of obligation at a discount. They have not so far succeeded. What will be the fate of this type of transaction would obviously depend, because CLBO is basically RBI-backed money-making instrument where with the collateral of the government guilds, right? It is with the guilds as a collateral, and which is to be actually repaid at the fixed interval, fixed point of time along with interest. Now in that, whether it will be leviable, as my personal opinion is this cannot be subjected to tax at all. The problem here arises is, world over, majority of the countries have actually excluded financial services from the VAT or GST structure. Some of them have called it zero rated. For the simple reason that in financial transaction, it is very difficult to determine the value addition because it is normally in the form of interest or dividend or so you can't really determine what is the actual value addition. Banking service, they earn on lending and they pay on deposits. Now, how do you determine what is value addition between deposits and my fund, which I am lending to others and earning interest out of this? So traditionally, it has been kept outside the purview of GST, but in India, we have been fee-based activities and fund-based activities. We have been able to capture all fee-based activities under the service tax. This will continue under GST without any doubts. And fund-based activities, we have been able to capture many transactions on the basis of the notional valuation, which we have been able to do. So here this problem can arise. Mandated lead agents appointed outside India, Tata Steel case. Mandated lead agents appointed by Tata, which arranges the fund, including the domestic funds and funds from abroad for the purchase of assets abroad, whether liable to service tax or not. This question arose in Tata Steel, and with the majority judgment, the tribunal has held this is liable to service tax under reverse charge. Even though the assets is situated abroad, the fund is arranged for buying the assets abroad, still it is liable to service tax. This principle probably can come in play in such type of transactions even under GST in the context of place of supply. Because property related place of supply is where the property is situated. But we are not talking about the property per se, we are talking about the charges which I am paying to the arranging banks, which might be situated abroad and which might be in India. It is my question of charging them, my paying them arranging fees for my buying of the asset abroad. The delayed payment charges, whether payable, chargeable to GST. Section 15, subsection 2, clause D says, interest or late fee or penalty for delayed payment of any consideration shall be liable to GST. Interest or late fee or penalty for delayed payment of any consideration shall be liable to GST. This is now covered. The question can arise mainly that what is part of the consideration and what is not part of the consideration. Generally, this issue has arisen in the context of transaction charges which are levied by the stock exchanges, which are recovered from the customer and when they make it pay, because you have to pay it upfront. Stockbrokers will have to pay it upfront. And when the customer delays it, for which delayed payment charges are recovered. Service tax is definitely not applicable. However, under GST, then the question is whether these transaction charges which are levied by BSE or NSE, can it be treated as a part of the consideration? Because it is only the delayed payment of consideration, any charges recovered, which would be subjected to. So again, there could be some litigious issues on this point. Then, levy of service by the sub-brokers GST situated in J&K, providing the services of dealing, assisting, etc. to the J&K based, Jammu Kashmir based investors where the accounts are maintained either in Mumbai or elsewhere in the country. This question is important because for the time being, GST laws are also not extended to Jammu and Kashmir. So, if the sub-broker is situated in Jammu and Kashmir, investors are in Jammu and Kashmir, then even though the contract note is issued by the main broker for Bombay, the service tax law, the judgment says, Religare Securities Limited, service tax is not applicable because Section 64 does not extend to J&K. Today, GST laws also do not extend to Jammu and Kashmir. Probably the same principle can be made applicable in respect of J&K. Because J&K will have to have their own laws first, and thereafter it will be aligned to the central GST. Till that time, again, this controversy can arise. The other part is, any advances in whatever form, any deposits which are taken, which are to be adjusted against the final consideration, the GST will be payable on that. Which are today also, because service tax, Section 66B says, the service tax to be levied on any value of services which are provided or agreed to be provided. So you receive the advance and tax is payable. This principle has been continued. If it is a refundable deposit, this can probably create havoc for the goods manufacturers. Service sectors, we are mostly used to any advance because point of taxation rules 2011, it is date of receipt of payment, date of issue of invoice, or date of completion of service, whichever is earlier. The same principle is continued under time and value of supply. Under chapter time and value of supply, more or less same principle, whichever is the earlier. So therefore, but it is now made very specific, any amount which is received as a deposit will not be part of the taxable value unless it is adjusted or to be adjusted against the final consideration. So if it is a refundable deposit, no tax. So that is, and these are the major operational part of it. Two other points only, and that e-way bill I said. Other point is about the anti-profiteering measure. Anti-profiteering measure, I think it is simply a provision made playing to the gallery just to pacify the ruffle feathers that GST will not result into inflationary pressure and all that. It will result into inflationary pressure. There is no way one can decide whether the benefit has been passed on or not. There is no mechanism. They will be only enacting an authority to get into that. Most of the countries have anti-profiteering laws, but they have hardly succeeded into this. We already have the Competition Act. Why should we get into this? That's a different matter. And the second one is GST compliance rating. There will be a rating which will be given to every taxpayer, and if necessary, it can be put even under the public domain. Okay, this is the rating of this particular person. Based on that, the other people can decide whether to do business with you or not. This may become important between the trade in the market, okay, whether I should buy the goods from him or not. Compliance rating will also mean that the people managing the indirect tax function in the company will always be under stress. Because poor the compliance rating, the management may not take. Management may say that, okay, I have spent so much of money for you to attend the seminars of Sailesh Bhai and XYZ and all that. I'm sure you must have become now master of GST. Then why we have a poor compliance rating? And 3 returns in a month with 37 returns in a year, 10, 15 and 20, it means that the people who are undertaking, who are in charge of the indirect tax function should forget about their leaves forever between 10 to 20. Even if you have to go to somebody's condolence meet or you have to get married also, do not get married between 10 to 20. The message is loud and clear, no leave. So these are certain, there are quite a few many, but as I said, I thought I have already opened up the Pandora's box enough, but these are all important because these are all going to be the reality. All these provisions are going to be the reality in the coming days. So therefore you have got to be prepared on every single aspect, and I can only wish you a very good luck. If time permits, we can also have a couple of questions, otherwise we can conclude the session. Thank you very much.